6 years old. And so now, moving on to today's presentation. Let's start with the outlook. What's happening in the world? What's happening in the U.S. economy? I have to say I've been doing this presentation for many years. I have never been more pleased. And that's an odd sort of thing to say in 2018, given that, real estate's really expensive. But the nice thing is that the global growth rate that we are projecting in 2018, and that's from Bloomberg, is actually the strongest in 7 years. And that makes me really happy because the global growth rate really affects what happens in U.S. real estate, both for single family and for multifamily. And by the way, before somebody asks me, today's presentation is really not a multifamily presentation. It is a single family presentation. 80% of what I'm going to say applies to multifamily, but it is not meant to be a multifamily presentation. Okay? It probably applies really well out to multifamily of 20 or 30 units. But if you're above that level, there are a number of caveats. A number of the cities that I'm going to show you today may not necessarily be the best above that number of 30 units. All right, back to Bloomberg, right? So again, a stronger economy than we've had in the past, and that was the world. But for the U.S., the International Monetary Fund, or the IMF, actually projects that the U.S. is going to have above trend growth. And the reason is fairly obvious, right? It's the Trump tax overhaul. And I'm not talking about the money that the Trump tax overhaul puts into individual people's pocket. To be honest, those numbers are very small. But I'm talking about the massive reduction in the corporate tax rate from 35 to 21. That is gigantic. When you compare that to the tax cuts that individuals got, right, those were much, much smaller. But companies are flush with cash. A lot of this cash was held offshore. Now they can pay smaller amount of taxes, bring that money back in here. Now, some of it is going to end up in your pockets, right? If you're in the stock market, it's going to end up in your pockets. But a significant portion of it will be reinvested by those companies into the economy, and that's what gives you above trend growth. Now, the bad news is it's not expected to last. It's expected to give the economy a big boost in 2018 and a small boost in 2019, and then after that, nothing much really. But for the next 2 years, you should see above trend growth, with 2018 being higher than 2019. So that's the short-term good news. Now, let's look at, consumer prices, right? Because that's an indicator of whether the economy is doing well. And sure enough, in January, we saw a jump in consumer prices. Now, on the 14th of February, that's 5 or 6 days ago, the stock market had a conniption, right? You guys saw that? Like, stock market went a little bit insane. And you know what was odd about that conniption? It was all good news. It was all news about consumer prices being higher and wages being higher. And you think about that and go, wait a minute. The stock market had a conniption because consumer prices were higher and wages were higher? Yes. The reason for that is that was the day when everyone in the U.S. came to the absolute realization that we were beyond the low interest rate environment. Those numbers made it impossible for anybody on the Federal Reserve to argue that they should not raise rates, which means that at this point, at least 3 interest rate hikes for 2018 are locked in. That's a quarter point each. And more likely, there are 4 interest rate hikes coming in 2018. And that impacts real estate, and not particularly in a good way. So we're going to talk about that. So there's good news and bad news. Yes, the economy is going to do better. Yes, the unemployment rate's going down, wages are going up. There's some inflation, which is always good for business, right? You want to charge people higher rents, so you want inflation. So that's good news. But if you're buying today or buying over the next year, you're going to have to deal with the impact of the higher interest rates.